Good.
Yes, sir.
All right. Hello, my name is Matt Lutz. I'm a recent graduate of St. John's University, and I've been working at Best Buy here for about 3 months now in their finance department. I'd like to talk about how we analyze financial statements and kind of what we look at when we're analyzing them. So there's 3 components of a financial statement. It's our balance sheet, our income statement, and statement of cash flow. First, we look at the balance sheet, which reports all assets, liabilities, and stockholder equity. And we look at some key ratios when we're looking at the balance sheet. We look at debt to equity ratio, which is our total debt divided by our total stockholder equity. And this is a leverage ratio that we use that shows our investors the risk that we have. Then we look at our current ratio, which is a liquidity ratio, and it shows if we can fill out our short-term obligations and our debt for that. And we use current assets divided by current liabilities. Then we have a quick ratio, which is very similar to current ratio, except it takes our current assets, except for inventory, and divide that by our current liabilities and our current debt. And this kind of just shows how much our inventory really takes up of our current assets and kind of informs us on if we need to lower our inventory. So when we do these calculations, I have them on their handout here. We find out our debt to equity ratio is 2.977. In the retail market, it's a little high. It kind of shows our investors it's a little bit riskier to invest in us. So it shows us as finance people that we really want to lower that and gives us an idea on what we want for the future. Then our current ratio is 1.25, which is above 1 and means that we can pay off our obligations. This is good to see since if it's below 1, then we can't pay off our debt. And then when we go to quick ratio and we see it's below 1, it really shows us how our inventory is above about half of our current assets, as you can see on our balance sheet here from this past year. And will just show us for the future that we need to probably lower inventory to be able to pay off our debt. The second part we look at is the income statement, which just delivers all revenue and expense reports. And we do this by doing a vertical analysis where we take all components of the income statement and kind of go over the percentages to our total revenue. We also use some key ratios when we're using the income statement, either cost of goods sold ratio, our gross profit ratio, which are both inversely related, where it's our gross profit divided by total revenue for our gross profit margin, and then our cost of revenue divided by total revenue to find our cost of goods sold ratio. Then we use our income tax ratio. This kind of just gives us an idea on how much tax there is for our company over the span of the year. And it's gonna change since the corporate tax rate will change this upcoming year. So it's good to see how much percentage of taxes we have. Then our profit margin shows our net income divided by our revenues and just gives us an idea on how much total profit we're actually making based on our revenues for the whole year. So on the back side, I have the examples of the calculations, and we have our income statement here, which are highlighted with our key components of gross profit, income before taxes, and our net income. And we find out that our cost of goods sold is 76%. This is pretty good for a retail market. We really want to make about 25% profit on every good. And then our gross profit margin is inversely related to our cost of goods sold at 23%. Our income tax rate is 45% for this past year and should be lower this next year, but it's always good to visualize and see how much taxes are getting taken out. Then our profit margin is 2.3%, and it's a little lower than what we want. It just shows that our expenses really take up a lot of our revenue, and we can use this for the future in forecasting what our income statement is going to look like for the next year, and even look at previous years to see the trend if it's increasing our net income. The last step that we look at for is statement of cash flows. Cash flows is just basically the overview of everything that comes in and out of the business. And we have 3 structures: the operating activities, which is everything sold on the income statement, any loan taken out, liabilities, and it kind of just shows you what's going in and out of the business cash-wise. Then we have our investing activities, which are any fixed assets that we buy throughout a year or any investments that we use. If that is investing in the stock market, investing in investors. Then we look at financing activities, which are loans taken out, for any big projects that we have or dividends that we pay for on our investors that invest in us. The finance statements allow us to project future earnings and also allows us to look back on how the company is doing over the last couple of years and kind of project if we're growing as a company or decreasing as a company. And we kind of look at every certain aspect if it's going to be good for our business to invest more. Thank you.